So what
Leave
about
your,
now?
yeah, leave your video on and see if I can record it. So I can kick that off. All right, so welcome everyone to this evening's webinar on the CARES Act for real estate investors. I know from speaking to many of you in the past several weeks that everyone's schedule these days is even more packed than usual. So I truly want to thank each of you to taking part of your valuable day and joining us for today's webinar. And I hope you find it beneficial. We're very excited to have Angie Bhasin as our guest speaker, who has a lot of experience and expertise in this area. We're very thankful for her time as well. And I know each of you will certainly get much benefit from her presentation, as well as the added opportunity to ask questions live on today's webinar. So we're really excited about that. Before we get started, I want to go over a couple logistical items. Right now, we do have everyone on mute except the presenters, and so if you do have a question, you should be able to submit the question in the chat feature at any time during the presentation. Angie has a lot of content to go through, so we'll address the questions at the end of today's session as we have time. And again, this is a reminder that we will be recording today's session, and you'll get a link to that recording as well. So in case you have to drop off early, or miss portions of it, the recording will go out. Before I hand it off to Angie, wanted to go through a really short intro into Spur Equity. So let's start out with introductions of who we are. Rav, I'll let you introduce yourself first.
Sounds good. Thanks, Param, and thank you for joining us this evening. My name is Rav Singh, and I'm the co-founder and principal of Spur Equity. I moved to San Antonio from Des Moines, Iowa, about 16 years ago. I'm a licensed real estate broker in Texas, and I earned my CCM designation over 9 years ago. For the last 14 years, my main focus has been brokering hotels and investment properties for my clients. While I work to find great opportunities, for my clients in that space in Texas and actually all over beyond, but for myself and my family, I've focused to invest in the multifamily property space, mainly in the apartments, because I've seen that sector to be the safest and most recession-resistant asset class around. So I'm really looking forward to hearing what Angie has to share with us today.
And good evening. My name is Param Singh. I'm the other co-founder and principal of Spur Equity. I'm originally from the East Coast, but now I've been in San Antonio for the last 14 years with my wife and 3 children. From a career standpoint, I'm a director of a specialized consulting practice in a global IT and management consulting firm. And have been managing sales, delivery, and pipeline for that part of the business for over 12 years. I've been working in management consulting for over 20 years. From an investment standpoint, Rav and I individually each started investing in real estate over 15 years ago in a variety of different real estate sectors, including single family, small multifamily, commercial real estate. But we decided to sort of join forces about three or 4 years ago, and together and started focusing mainly on multifamily investments. As Rav mentioned, they're the safest. We found that they're the safest, most recession-resistant asset classes. So with the success that we've had as independent rental owners, we've now shifted that focus to a larger multifamily syndication model, so we can help our investor partners grow their wealth in the same way through a proven strategic model in this lower risk space of commercial multifamily. And now we've owned and managed over 575 units in Texas and Florida markets. So a bit more detail on what we focus on. Well, as mentioned in our introduction, we primarily focus on multifamily investments, and our experience has been, again, safest investment class historically, even with the unprecedented COVID situation, where hospitality and retail sectors have been hit extremely hard. Multifamily still manages to thrive. So, we try to focus on that. We're also focused on short to midterm value add investments. So we're not looking at anything from a long-term hold. perspective, because our focus is really growing wealth. So short to midterm holds, like 3 to 5 years seems to be the best model for that. We don't look for distressed properties, but rather stabilized properties that are already generating cash flow from day one. And we look for opportunities to increase that cash flow in terms of, that will increase the overall value of the property as well. We've started with smaller properties, but, we've seen that focusing on properties that are 100 units and above as a guideline gives us sort of maximum efficiency with payroll and resources and other expenses, and truly lets us take advantage of economies of scale. And through this model and proven approach, our goal is to maximize our returns for our investors through that consistent cash flow and profits from the ultimate sale of the property. So just to close this out, this intro out, why do our investors and partners collaborate with us? With Rav's detailed sort of professional experience in real estate and our collective investment experience and expertise really provide a good foundation for joint investment strategy. We have a proven track record with multifamily investments that kind of speaks for itself. And we've chosen to invest in our own properties first and kind of refine and developed a very focused investment model, which we've then taken to our investment partners through a strategy that we've introduced, some of the most effective and efficient methods of wealth growth. This last point here, what we found in multifamily investment space is that it's a team sport. And you're going to hear that term very often in multifamily. You're only as strong as your team when it comes to multifamily investments. And that's, one of the things that actually drew us more and more into the space. When putting a deal together, you're truly partnering and collaborating with various partners from property management, lenders, lawyers, and insurance agents, brokers, tax professionals, and other sponsors. So it's through that collaborative environment that Rav and I got an opportunity to learn from others and increase our own knowledge. And since we've benefited from that ourselves, our team values both wealth growth as well as knowledge growth. And we love partnering with partners that have that same belief, which is why we are extremely excited to have Angie Bhasin with us today, so she can share her knowledge with us today. So with that, I'm going to actually let Rav introduce Angie, and then we'll hand over the rest of the presentation to her. Rav?
Sounds good. Well, I'm pleased to introduce Angie Bhasin to you guys this evening. Angie, from a professional standpoint, is a certified public accountant practicing in California and is an expert in tax law and compliance, and works with clients in multiple areas such as real estate, consulting, construction, manufacturing, and beyond. She's very passionate about her role in advising clients on the tax benefits, and we're going to learn a lot more about that today. Angie's not only a presenter with us today, but she's also a passive investor in our projects. She is very knowledgeable about the syndication structure that we use that can provide very specific tax benefits that generate from these projects. And this is how individuals can take advantage of them. And, as you know, there are many folks who are experts in their fields, but the partners that we align ourselves to are the ones that share the knowledge with clients and partners. And that is what impressed us about Angie. She regularly hosts webinars and meetings, and she shares deep insight and knowledge over email and over just multiple other ways of informing people about the various benefits that you can take and get advantage of. So we're very fortunate to have Angie with us today, as she'll provide us with lots of learning opportunities just so we can grow in this space together. And with that, I'm going to turn over to Angie, who's going to give you a full explanation of where she's coming from. Angie?
Thank you. Thank you. That was a really warm welcome. Appreciate it. I'm happy to be here. Now, I am going to be sharing my screen. So I am the host. I'm just going to go ahead and start screen here. Okay. Hopefully you can all see my screen.
Yep. Good.
Perfect. Well, thank you. Again, I'm really happy to be here, and I'm really looking forward to a great discussion today. It's all about CARES Act and what it really means for us folks in the real estate industry. I love your tagline, wealth growth comes with knowledge growth. I totally resonate with that. And I'm glad to be partnering with you on that. So let's dive right into it. We do have a lot of matter to talk about, and I want to make sure we have some time in the end to take questions as well. And as Param, you mentioned, let's have everybody drop in the questions as we go along, and then we can take them in the end, as many as we can. But if we don't get to all the questions, I want to make sure that you are able to. I'm sure we have you have my email address over here. You can email your questions. I'll be happy to get back to you. Let me start with our standard disclosure. This presentation is not legal or tax advice. My goal over here is to just make you aware of the changes in tax law and how you may be able to benefit from them. Now remember, everybody's situation is unique, and you need to work with a tax provider or specialist, actually, who's abreast of all the changes so that they can analyze it at your individual level. There's hundreds of strategies and thousands of combinations, and there's no one size fit all. So very important to talk to your provider and see what you can benefit from in your unique situation. And to top it all, I mean, like we were just saying, there's been so many changes that some of the things that we may talk about today may not be relevant tomorrow. So very important to stay abreast of it. So that's our topic for today, COVID-19 tax law changes and what does it mean for you? I want to take a few minutes to here talk about planning and how important planning is. You know, sadly, and I see this in my practice every day, proactive tax planning being so critical, yet it's so underutilized. Before I dive into the mechanics, I just want to kind of give you a little bit of what tax planning is. If anybody knows how much tax Amazon paid in 2018, remember they had $11 billion in profits. Do you know how much tax they paid? Any guesses? Drop it in the chat box if you think. If you think that they didn't pay any tax, I want to say you're right. They didn't pay any tax. But those of you who said they didn't pay zero tax, remember, they got $129 million back from the IRS. Did they not only not pay tax, but they got money back? And that's right. And you know why? Because they have a team of tax strategists who are working for them. And their sole job is to research applicable strategies for them so they can reduce their taxes. Now remember, the tax code is the same for everyone. The big corps and billionaires have huge tax research departments that work on their behalf, but it's the small taxpayers that don't have access to these services. So really that's, Rob, you said it right, that's what I'm so passionate about, bringing this awareness to common taxpayers just like us, and then bringing these strategies to the common taxpayer so we can all benefit from it. And like I said, in my practice, I see this every day. Folks think that their tax preparer, their CPA, their EA are planning for them, but believe me, before my extensive training as a certified tax planner, I thought so too, right? But it's really not proactive tax planning generally what's done. And 99% of CPAs, as CPAs, we're trained to prepare tax returns, but not to plan. And so that's my big appeal for the day today. Make sure that you're talking to a forward-thinking strategist who can actually help you position yourself so that when it comes time to do tax returns, you're in a better place. Generally taking your data to a tax preparer after the year is over, it's historical data. There's not much you can do. So you need to be working with the planner during the year so that they can actually look at things you can benefit from it. Okay, so that's my spiel for today for tax planning. Let's move on to humor me on that. So let's move on to the topics. So our agenda for today, there's a lot to cover again, and I'm going to try to be brief, yet I want to cover the points, the relevant points, and then if anybody has questions, we can go deeper into those. We have to start with the brief update of PPP. I mean, this is the talk of the town, and there has been some major changes that were signed into act on Friday. We'll talk about that regarding the PPP Loan Forgiveness Flexibility Act. We'll address the stimulus checks briefly, and then I'll talk about big changes in depreciation rules that will affect a lot of real estate investors. We'll talk about some opportunities for real estate investors as well as self-employed workers, which is kind of new because, and we'll talk about that. Generally, self-employed, like Uber drivers or, independent contractors, they kind of fall down the cracks that they don't get the benefits of the whole tax law. But CARES Act actually took care of that, so we'll talk about that. Then we'll also talk about changes to the retirement acts, the retirement accounts. You'll find that very beneficial and can get you thinking of how you can kind of benefit from these changes in your unique situation. All right, the first one being the PPP loan. I'm sure everyone is aware of this. This has been highly promoted in media as well, and rightfully so. The Congress passed this act to make sure that employers don't, let go of employees. So it's a paycheck protection plan. I'm not going to go into the details for the application, as I'm assuming if most of you who are eligible may have already applied. But again, if you have specific questions, drop them in the chat box. Now, the PPP loan has very attractive terms, 1% interest payable over 2 years, and which there's been changes on that, and no payments. You don't have to make any payments for 6 months. So I want to talk about a little bit about what the actual act was, but then how did it change now with the new Flexibility Act? So when the act first was signed, there was the split was 75% of the loan proceeds had to be used for payroll and 25% for utilities or rent or mortgage interest or even lease payments. And this was, and we'll see, and a lot of you, if you've gotten the PPP and if you know what the challenges were, this act, Flexibility Act, is really a welcome news. So what they have done is they've changed the percentage from 75%, 25% to 60%, 40%. But what's happened is the original PPP loan guidelines, they mandated that 75% of any forgiven amount had to be spent on payroll costs. And now the Flexibility Act reduces the requirement of payroll expense to 60% of the loan amount. So there's a little bit of a difference over there. But for the most part, and we'll see because of the second point, they increase the term or the covered period from 8 weeks to 24 weeks. And that's what it's really welcome, because a lot of businesses are going to be able to have this be forgiven because of that increased period. Excuse me. But again, even though it's very favorable, I want to caution you, make sure that you are documenting it right, doing it right, because you do want this loan to be forgiven. And just a little bit of background for those of you who may not know, the idea was to grant this loan and have the loan proceeds be used for specifically for payroll, mainly for payroll, 75%. And then if you followed the guidelines and if you use the money in the right way, you could get this forgiven. So it's a huge deal. It could be free money, but you want to make sure that you're doing it right, you're documenting it right, because at the end of the covered period, you have to apply for forgiveness with the lender. and they're going to require documentation. Now, there is some talk, I don't know if that will pass or no, but there is some talk that loans up to $150,000, they're being requested that they be forgiven without any documentation at all. So we'll see how that goes. Now that, I don't know if that is the right way to do it or no, because that might lead to a lot of fraud related circumstances as well, but we'll see. We'll see what comes out of that. So this change was actually a result of a lot of complaints from many businesses. A lot of businesses had not started opening yet. Even if they open, and we'll see in a later slide regarding unemployment, a lot of the workers started getting unemployment and getting, in some cases, better wages or better compensation than even when they were employed, and they didn't want to come back to work, or they didn't want to come back to work for health reasons, for sanitation reasons. So a lot of businesses were actually not sure how this was going to go. So the Flexibility Act is a result of that. And then also the other thing that happened is, even though the landlords were kind of encouraged or instructed to be lenient, not all landlords were being lenient on rent. So the business owners were getting caught in between two really hard rocks. So the second point, the second big deal that changed with this, which is self-explanatory, and I dove into that, was they changed the cover period from 8 weeks to 24 weeks. So when you got your loan, it was supposed to be, you were supposed to use those funds in 8 weeks from the date you got funded. And then if you used it appropriately, 75% for payroll, 25% for the other appropriate costs, you could get that forgiven. Now they have increased that term to 24 weeks. So in most cases, unless there is a different circumstance, there's no reason why you won't be able to use up these funds for payroll, right? I mean, because the loan amount was based on your average payroll for the prior year times 2.5 for 2.5 months. So if it's 2.5 months, more than likely you'll be able to use it up in 24 weeks. And for some businesses who probably have not gotten funded yet, or may later, it's going to be, the period is going to be earlier of 24 weeks or December 31st. The next point, again, this is great news. Borrowers can now push past the 6/30/2020 deadline. Originally, the Congress had said that if you laid off any employees, you had to rehire them by June 30th in order to be eligible for forgiveness. Now that's all the way through December 31st. Again, this is all related to the shelter in place. A lot of businesses were not opening because of shelter in place, and so this really comes as a welcome. Now, again, there might be some businesses. We'll see what happens with this next wave. Hopefully it's not bad, and hopefully all businesses can open, but there might be some I can think of that may not open, and they may have some difficulty with the forgiveness. You're now able to document that if you try to hire your staff in good faith from February 15th through December 31st, and if you're unable to do so, what they have given the liberty to make sure that you document that you tried to hire, they refused for whatever reason, whether it was for social distancing, sanitation, whatever have you, and they refused to come back. You can document that, and that will not affect your loan forgiveness. Because part of the loan forgiveness was that you had to maintain the number of employees had to be the same as they were in 2019. So that's again relaxed. The loan term has been extended from 2 years to 5 years. Again, I mean, this is it's a really good deal. And there really are, the Congress really did try to make sure the small businesses, which really is the backbone of our economy, is not hurt. And the other big thing was originally in the act, the PPP, if you got the PPP, you could not defer your payroll taxes. And they have retracted that. So now you can actually, and we'll talk a little bit more about the deferral of payroll taxes in a later slide.
Hey, Angie, I know we said we'll save the questions for later, but there's two questions on this, if you wouldn't mind.
Sure.
On the slide. One was a question on the PPP forgiveness amount. What is you mentioned, what was the maximum amount from a forgiveness standpoint? Has that changed in this Flexibility Act?
No, the amount has not changed. It's the percentage. So if you say you got a PPP loan of $100,000 and you did spend 60-40 split, but accurately, you can still get 100% of those funds forgiven. As
Okay.
long as they're being used for in the appropriate manner.
In the appropriate manner. Okay, perfect. And then the second question was, if we have one company and then we have two DBAs under that company, do you apply for two PPP loans, or is it one if there's two businesses underneath?
So the DBA is really, you don't have a separate EIN for it, right? So it would be the company that the loan would be associated with the EIN of the company.
Perfect. Thank you.
Sure. All right. So great questions. Let's move on to the second topic that I want to touch on today. This is, a lot of you may have already received your stimulus checks. This was a $1,200 per person economic impact payments. That's what the IRS ended up calling it after several variations of the name. And some may be getting them as checks if you had not provided your bank info for direct deposit. Now, I want to make a couple of points over here. You have to remember this is an advance on 2020 taxes, kind of like what happened in 2008. So the $1,200 per taxpayer or $2,400 per married filing joint or $1,750 for head of household. Now some of you may say, oh, I make too much money to bother about this and may ignore it. But remember, this is a credit for 2020 taxes. And this presents huge planning opportunities. Perhaps you can take advantage of some sort of planning. I mean, perhaps you lost your job and now you're in this period where you don't have income, and maybe your income dropped to a lower within those phase out range, or maybe you can perhaps take advantage of real estate professional status, and we'll talk about that a little bit too. So don't dismiss it just on the front end, because there could be opportunities to plan around this. Perhaps you can plan for your children to qualify for this credit. So thinking ahead and planning can really provide savings on this. And again, you have to remember that this is an advance that the IRS is giving based on income reported on 2019 tax return. And if 2019 tax return is not filed, then the IRS is basing this on the 2018 taxes. So again, another opportunity, if you haven't filed your 2019 tax return and you qualify based on 2018 tax return, you want to take advantage of this extension of deadline and not file right now, so that IRS can base your advance on your 18 tax return. And on the flip side, if you qualify based on 19 taxes, then you want to go ahead and file your tax return, even though the extension is extended, the deadline is extended, so that you can get this advance. And remember, why I'm saying this is because the IRS has said that if you get this advance based on your 2019 or 2018 income, and when you file your 2020 taxes, and your income is above the threshold, you don't have to return the payment. So, you have an opportunity to perhaps yourself or for your children, or kind of think about it. At least the idea over here is to get you to start thinking about other ways. Think outside the box. I am going to now move on to my third point, which is the deductions for real estate professionals. And this probably relates to quite a few of our audience today. Let's talk about what it means to be a real estate professional and why it's important. And we have to start by kind of looking at and determining what is your status. So let's talk a little bit about this. The rules depend on your status. The tax rules depend on your status. And the status depends upon the level of activity that you have in real estate. So let's talk about the real estate investor versus real estate dealer, and then we'll talk about the real estate professional. So real estate investor is somebody, say you have a full-time job and you have a couple of rental properties that you're renting out. That you are a real estate investor. You are a passive investor. That's where Rav and Perm kind of fill in the blocks and provide those kind of opportunities to invest for passive. You generally will report your income and expenses on Schedule E of your 1040. You would take depreciation. And like I said, this would be passive income to you, kind of like a side income to you. If you have losses in this passive activity, you can deduct them only up to a certain amount, at a certain limit, and that's based on your AGI. So if you have losses, you cannot deduct them against your other income. If your income is over $100,000 for single and $150,000 for married filing joint, what happens is it gets suspended. It gets put away in a different bucket until you sell that property or until you have other passive income to offset against those losses. So keep that in mind, and we'll kind of compare that to real estate professional when we get there. Now remember, this income is not subject to self-employment taxes because it's passive income. It's not your ordinary income. It's not something that you do as a every day of your life if you're a passive investor. And then you have some other benefits. When you sell that property, you're subject to capital gains taxes, which could be a max of 23.8% for federal, and depending, what state you are in, state tax rates will apply. And then you can take advantage of 1031 exchanges. We're not going to talk about 1031 exchange today because that's another webinar in itself. But that again is a very, very powerful strategy that you can use with real estate. Now, the real estate dealer is somebody who kind of buys with the intent to resell quite in a short period of time, not like a real estate investor. Investor is like you buy and hold kind of thing, right? Dealer is dealer would be like a flipper. You flip homes. And tax implications are very different for dealer versus an investor. It is not passive income. It is ordinary income, so it would be subject to self-employment taxes. You cannot take depreciation, so you can't offset your income against depreciation. And your income is really ordinary income, like I said, and you can't take advantage of 1031 exchange. So there's advantages, there's disadvantages. Now, a real estate professional is really someone who has best of both worlds. And that's and that I see in my practice is something that reaps huge tax savings for my clients. A real estate professional is someone who is actively working in the real estate industry. And there are certain criteria. There's hours test and participation tests that you have to comply with. And you want to make sure you're doing it right, because this is something, if you got it, if you qualify, it's great. But if you don't, you don't want to fudge it, because this is an area that IRS looks at very, scrutinizes it a lot. So you want to make sure you're following the the rules in order to qualify for real estate professional. So real estate for a real estate professional, real estate is really your primary job. That's something you work on more than any other job. You spend more hours on real estate. 750 hours is the minimum that is required to qualify for a real estate professional. And being a real estate professional, that status can open up a slew of tax saving opportunities for you. Once you qualify and you want to make sure that you are following, like I said, the rules in order to be a real estate professional, your income is considered ordinary and your losses are considered ordinary. So how amazing is that? I mean, you could have losses from, paper losses. You always want to be cash positive, but paper losses because of depreciation. If you have losses, you can offset your other income. So this can be a hugely powerful strategy. And this is nothing new. This is not something that CARES Act brought into being. This is based on Code Section 469, which has been around for years. But I want to share this with you because this is a big deal. And at least in my practice, I see this all the time. What CARES Act has done now has amplified the benefits of being in this real estate professional status. First of all, I'm going to talk about this qualified improvement property fix. This is a huge correction and one that can possibly benefit some of you in a really massive way. In 2017, when Congress passed the TCJA, Tax Cuts Jobs Act, they intended qualified improvement property to be 15-year property and thus make it eligible for 100% bonus depreciation and also Section 179 expensing. But they made an error actually under the TCJA. The lawmakers made a mistake which caused QIP, qualified improvement property, to be 39-year property, and which made it ineligible for bonus depreciation. And that really adversely affected a lot of real estate investors and folks who invest in commercial property, because they could not take advantage of this tax loophole, really. But the CARES Act actually fixed it. They corrected it retroactively, going back to 2017, end of 2017, December 2017. So any of you who made such improvements back in 18 and 19 and didn't take bonus depreciation now have the ability to go back and take advantage of this. I mean, this is huge. I think Robin Perm, if you look at your properties, this can bring really, really big cash refunds to you. And combine that with the provision that they said NOL carryback, they actually reinstated NOL carryback. Under the TCJA, they had eliminated the carryback of NOLs, and they said, okay, no more carryback, you can only carry it forward, and that also had limitations. Now this CARES Act actually reinstates NOL carryback. So if you were able to take advantage of bonus depreciation of qualified improvement property, create an NOL, you can carry it back, amend your returns, and get refunds. I mean, this is huge. And you want to make sure that your unique situation, you are able to capture these benefits, because this is a law, but doesn't mean everybody is eligible for it, or even if they're eligible for it, it benefits them, right? Because sometimes you might want to think, in your unique situation, maybe carryback doesn't make sense, and you do want to carry it forward because that's going to bring you better tax advantage. So it has to be analyzed on your unique situation.
Definitely talk to your CPA to get advice, because what I'm hearing is that you can retroactively go back, amend your taxes because of the QIP property fix law that got fixed and take advantage of some of that scenarios you just talked about.
Yes, yes.
So one question I have is like if you talked about bonus depreciation, and we all know like if this is retroactive, does that mean that we didn't need to, we can retroactively go back and do even a segregation study and like we can do all of that retroactively essentially? Or
The
just the
cost
bonus
segregation
depreciation?
study?
Yeah,
Well, cost segregation study, you cannot do it retroactively, right?
right. So the
It's
bonus
done by
depreciation,
the,
how do we?
yeah. But say, I mean, and that's another example, right? It's based on your unique situation. If you didn't get a cost seg done at that time,
Right.
you may do it now, and then there's a way that you can utilize that. There's a form that you can fill and actually catch up on that in
Catch
this
up on
year.
that.
Yeah,
Perfect. Okay, great.
great question. So the next point over here, how are we doing on time? Oh, I better hurry up.
Yeah, we're at 7:42.
Yeah, I think we're
A lot of
pretty
good content though, so.
good. Great. Okay. So the next point, it's real quickly, we all know the extension of the deadline. The CARES Act extended the due dates for all tax filings. We're aware of our 1040s and our business, but what they also did was relax the deadlines for investing in qualified opportunity zone. Again, this is not a topic that we can go into today, but just briefly, what the QOZ is. In 2017, under the TCJA, Congress passed this legislation, which basically increases or stimulates investment in underdevelopment communities all across the country. And they gave huge benefits for taxpayers to invest their capital gains in such investments. And again, this is a tremendous strategy in the right situation. So the CARES Act actually, so what the way it works is, in order to be able to take benefit of the QOZ investment, you have to invest in this fund or in the qualified opportunity zone. And we can talk about this another time in more detail, but you have to invest within 180 days. Now, what the CARES Act did is, if your 180 days fell within April 15th and July 15th, they said, okay, you can wait until, so they kind of extended that deadline too, which is great, which, in some cases, in one of my clients' case, it really benefited him because we were able to really help him save like $58,000 just using this one strategy. So it can be humongous. It depends on your situation. Now, the CARES Act also relaxed the deadline requirements for 1031 exchange. For those of you who are not familiar, there's two deadlines in a 1031 exchange. There's a 45-day deadline, which you have to identify your replacement property within 45 days, or the 180 days, which is you have to purchase your replacement property. So the CARES Act extended both the deadlines. So if any of those deadlines fell between April and July, it got extended to July. Real quickly, some of the other big provisions of the CARES Act, we touched on unemployment. Again, I want to point out over here, as I mentioned earlier when we first started, all of these provisions are available for self-employed workers as well, independent consultants, gig workers like Uber drivers, Airbnb. So generally, this sector of economy falls into a gap, as they are not employed and they're not your traditional businesses with employees. But CARES Act actually took care of this and have allowed the self-employed to partake in all of these provisions, just like any other business with employees. And the ability to take PPP loan, or the ability to apply for unemployment, or the other provisions that we're going to talk about. So unemployment, in addition to the state unemployment, federal government is providing an additional $600 a week, which in some cases, if you add those two up, it can be more than $1,000 a week. So pretty good incentives over here, trying to make sure that the economy kind of stays afloat. Paid leave, again, I'm not going to go too much deeper into this, but the Coronavirus Relief Act that passed right before the CARES Act added a new reason for 12 weeks of leave for any period. Beginning April 1st through December is if you have a qualifying need related to COVID-19, whether if you suffered, you meaning the employee suffered, and again, I want to point out, this is eligible for self-employed as well. So as a self-employed, you are an employee of your business. So this, remember that this applies to you as well. You could take advantage of these. There's specific rules and qualifying criteria, and I suggest you talk to your HR specialist because these are HR related rules and you want to make sure that you're doing it the right way. Then real quickly, payroll tax credit. Employers who paid family or sick leave as required by the Coronavirus Relief Act that we just talked about, they can get another credit based on these payments on their employer portion of payroll taxes. And in some cases, it could mean big dollars. So it needs to be determined based on each taxpayer's unique situation. Employer retention credit. Again, this can be a huge deal. And really, when at least a week ago, I was really insisting that people don't just blindly go for the PPP loan just because that's what everybody's talking about. You need to consider the employer retention credit as well. And I'll tell you what that is. This is a new credit that was created to encourage employers to retain employees, kind of like PPP. However, if you did PPP, you could not take advantage of the employer retention credit. And hence, that's why I was insisting, okay, before jumping into PPP, look at what is going to be more beneficial for you. For example, businesses who are not going to be able to open for the 8-week period, and they got the PPP, their PPP loan would not have been eligible for forgiveness. In their cases, the employer retention credit would have been more beneficial. Now, this Flexibility Act has actually changed that a bit, because now instead of 8 weeks, it's 24 weeks, and more than likely, most businesses will be able to get that forgiven, most. Now, this credit is equal to 50% of qualified wages that you pay to each employee up to $10,000. And it's done on a calendar year basis. So it's basically a $5,000 credit. Remember, it's a credit. It's a dollar for dollar reduction in taxes. It's not a deduction. It's a credit of $5,000 per employee. And in some cases, if you have a lot of employees, that could mean a lot of money. Again, the key over here is you cannot take this credit and get the PPP loan. So if you got the PPP loan, then you're not eligible to take this credit, which kind of is welcome. I mean, it's again, it depends on everybody's own situation. So you want to make sure that you get this analysis done. Again, I will just say that even though you got the PPP, I want to reiterate, even if you did get the PPP loan and you are all set to get it forgiven, make sure you get the documentation right, make sure you get the application right so that there's no hassles after your covered period is over. And we're helping our clients with all of this. And actually looking at, like I said, I mean, the CARES Act has just added so many more opportunities to tax plan and take advantage and reduce taxes. The last point over here I want to talk about is the deferral of payroll taxes. Now, the employers also have the ability to defer the payment of the employer portion of payroll taxes for 2 years. So if your employer portion of the payroll taxes for 2020, you do not have to pay for 2 years. So you can pay 50% in 2021 and the remaining 50% in 2022. Again, in an effort to conserve cash. In some cases, it may make perfect sense. The business is doing great. You may think, oh, I don't really want to defer it because then it's not like it's eliminated. I still have to pay it after 2 years. I don't want to do that. But in some cases, if things are kind of iffy, you don't know how the business is going to turn out. Maybe this is a good thing to do and reserve some cash and use it for the things that you need more. So again, depends on your unique situation. I think I keep saying that because that's just the bottom line here.
Yeah.
It all depends on your own situation. Okay, so let's get real quick to our last point, which again, I think this is a huge deal in the right circumstance. What I mean by that is, let me first talk about what the law was or is and how it's changed for 2020. Remember, these changes are only for 2020. So as you're aware, premature distribution from any qualified retirement plan is subject to 10% penalty in addition to taxes, right? And again, state penalties may vary, and state by state. California has a 4% penalty. But what CARES Act did was they said this 10% penalty will not apply to any distribution which is coronavirus related, up to $100,000 made in 2020. So, they said coronavirus related distribution, and then they had all these criteria. But if you look at the criteria, it's like if you're diagnosed with COVID-19, if your spouse or dependent is diagnosed with COVID-19, if you experience adverse financial consequences as a result of being quarantined or furloughed or laid off. Who hasn't been affected,
Sure.
right? In one way or the other.
Very broad.
Yeah, very broad, and it's really great because thank goodness you're not affected. We hope nobody is affected, but you are going to be able to take these distributions penalty free. You still have to pay taxes, but you don't have to pay taxes for 2 years. So what you could do is take these distributions if you wanted to. Again, planning opportunities, right? You could basically withdraw up to $100,000 from your retirement plan, penalty free. After 3 years, that's when you have to pay the taxes within 3 years. You could decide you want to pay back the distribution back to your plan, then you don't have any taxes. Or you may decide you don't want to pay it back and you just want to pay taxes on it, depending on, maybe your tax bracket is going to be different. Maybe you planned such that you can make better use of this $100,000 and take advantage of it. This may also be a great opportunity to see, that there's this great opportunity that we were just talking with Perm and Rav. They have this new opportunity coming up. Maybe it will be beneficial to take this distribution and invest in there, and that will bring better results. It all depends. Maybe this would be a good way to convert your traditional retirement account into a Roth account, creating tax-free retirement income. So for the right taxpayer, this could mean a huge deal, huge planning opportunities. And again, the same thing with loan from qualified plans. Your 401k, you could take loans up to $100,000 Under the old rule, you could borrow up to $50,000 from a qualified plan. Um, but now they've kind of increased that to $100,000. Of course, you have to pay, it's a loan, so this has to be paid back. But you can pay it back in 5 years, actually 6 years, because there is no payment for the first year. They gave a 1 year deferral. And you have to pay interest, but basically you're paying interest into your own account. So that's a big deal. And I would be really remiss to not mention self-directed IRAs here. That is a huge, huge opportunity to create wealth in real estate using your retirement account. Um, it's just phenomenal. And then if you really want to jazz it up, use your Roth IRA to invest. I mean, that's like blowing the retirement account, because you can grow your investment tax-free, and then when you take out the distributions, it's tax-free. That's a great way to build tax-free retirement.
Just want to give you a time check. We're kind of at 3 minutes, and we can go a little over if people are willing to stay with us. But I did want to. I don't know how much more content you have, but I wanted to make sure we have time for.
I'm all done for today.
What's that?
My last slide. Yes.
Okay, perfect.
So perfect timing.
Oh, great, excellent. So thank you so much. I think we do have a few questions. And so I'll try to moderate the questions a little bit, and then as people have additional questions, feel free to put them in the Q&A area or the chat. People have been using both. I think Chris asked a question about pulling money out of the 401k without penalty. I think you covered that on that last slide. So unless Chris, you have a follow-up, feel free to drop that. But I think Angie had answered that on that last slide. And then we did have some folks that took advantage of I guess whatever was available to them or whatever they knew about, and they got the $1,000 per employee, and I think that was the EIDL loan. And so some folks were a little bit confused about PPP versus EIDL, and so I think they got the $1,000 per employee, but they weren't able to take advantage of PPP. Is there something that they can do now to take advantage of that, or is that long and gone?
No, actually, yes, the PPP funds are still available. And if you are eligible, I mean, if you, whoever posted that question, if you want to post your details or maybe email them to me, if you're eligible, you can still apply. I mean, I'm still applying for my clients, and they're getting funded. Now, what makes you eligible is if you have employees. If you are an S corp or a C corp, and you have employees, it's based on your payroll. So
right.
If you're incorporated, it's based on your 941s, which is your payroll reports. If you are a sole proprietor, you file a Schedule C. It's based on your net income on your 2019 tax return. 2019 Schedule C, whatever your net income is, it's based on that. So if you're eligible and you haven't applied, give me a call. I'll be glad to help you. And the other point, we didn't touch on this, but the question, I thought that's where it was going. If you got the EIDL grant, which is, the $1,000 per employee grant, and you also got PPP, remember that grant is going to reduce your PPP forgiveness.
So one other, Steve had a question. If the PPP loan is ultimately forgiven, right, so you don't have to pay it back, does that loan amount basically count towards income since it is not payable?
Great question. No, that's the beauty of it.
That's great.
It's just free money. It's not taxable income.
That's excellent.
That's
excellent. We have one question. Can you, and maybe we need some additional information, but can you increase the question is, can you increase your PPP or EIDL loans if you've already taken
You
advantage
can
of that?
only get one PPP loan. If you've already got the PPP loan, you cannot.
You
As
can't do
of
it.
right now, you cannot get another one.
And then another question around
But
payroll.
I do want to say, sorry to interrupt. I do want to say, again, do not only look at PPP. There may
Yeah.
be other things that you could take advantage of to get cash. So don't shortchange yourself because there's lots of opportunities.
And I think that's the biggest takeaway from your presentation today is I think, you know, the PPP has been so widely publicized, and even the EIDLs, that people kind of jumped on them.
Mm.
But all of this other stuff, like even, you know, we just found out about the paid leave option, right, for self-employed. So a lot of folks that are on this call are self-employed, and you know, being able to take take sick leave from now until the end of the year and still get credit for that. That's free money if we're giving up if we don't take advantage of that. So that's the biggest takeaway I think from your presentation is there's multiple things that we can take advantage of, and you know what we're finding is folks are taking advantage of one or two of those aspects and not actually looking at across the board. So
Absolutely
that's a big thing.
because that's what's being talked about more. So you know that's what people are doing, and that's the reason. Well, in my practice, what I do is I offer like a complimentary. It's a 30-minute session to talk with folks who maybe they want to find out how we work or what we can do to help them. So we do a 30-minute consultation. We call that a strategy or discovery session.
Right.
And that I think really helps because, you know, there's so much uncertainty, whether it's CARES Act or it's just tax law in general. So that gives us an opportunity to kind of assess based on their situation, what we can do to help them. And then we share that with them.
Yeah, because based on their, you can customize specifically, understanding their situation, what are the things that they can take advantage of? What are they eligible for? What category do they fall into in terms of real estate, professional investor? And if, so there's certainly a lot that goes into that. So one question that I think someone had on the slide where you were talking about the individual household credits that are available. What did you mean by advance? So that you were saying that this is an advance of your 2020. So ultimately, you may need to. It's an advance from your 2020 return, essentially. And so, but there is a scenario where it could be forgiven as well, right? With some sort of threshold.
So I see what you're asking. So this is an advance. So for example, say we're doing our 2020 tax return and the tax liability, it turns out to be $50,000. So what they have done is that off of that $50,000, if you're married filing joint, you're going to get a credit, just like you would say like a child tax credit or any other credit, which reduces your tax by $2,400. So instead of taking it then in 2021, when you file your 2020 return, they're saying like, you can take this now.
You can take it now. Got it.
But the beauty is that you take it now based on 2019 income, or if you haven't filed your 2019 income, then it's based on your 2018 income. And if you qualify based on either one of those, you get this advance. But when you file your 2020 return and say your income is higher than the threshold, married filing joint, 198,000, and you really don't qualify, they're not going to take this back from you.
That's great.
Yeah.
Excellent. So I'm going to ask one more time if there are any. I believe we answered all the questions that came through, but if anyone has any other questions, feel free to put them in the chat box. But I like we were discussing, I think ideally if you have a CPA, great, you can kind of go to them and kind of go through everything that Angie laid out, but I would highly encourage you guys to set up that consultative session with Angie, so she can understand your situation and really give you an idea of what things that you can take advantage of. Because again, the biggest takeaway for me was that there's many different facets of, what we can take advantage of as part of the CARE Act, as part of this CARES Act. And we're only focusing on, one or two of those. So Angie, if you don't mind going to the last slide or the slide where your contact information is at. That way, people can note that down and contact you and see if there's, other things that they can take advantage of. Because, like I said, even the paid leave, it's, you may think it's a small thing, but, being able to get free credit for taking a sick day as a self-employed individual, that's a big deal. So, so I think that, and that there's, we have 6 months to take advantage of that. So there's plenty of things for us to look at.
Yeah, I mean, ultimately, as you said, Angie, it all boils down to your individual self, right? I mean, we owe it to ourselves. We need to go talk to professionals who can guide us based on, where our situation is, because there's a lot of stuff out there that we can take advantage of. And all we keep on hearing is PPP, EIDL, and so we owe it to ourselves, definitely, and our families, right, to do that. And that said, Angie, I want to, Parma and I, we both want to thank you very much for being here with us, and everybody else who were able to join us this evening. It's not easy, especially in the evenings, for you guys to spend some time with us. But ultimately, at the end of the day, we're trying to create partnerships with each other and learn from each other, because I often get reminded from the work that I do with my brokerage that we need to learn from each other, because knowledge is power. Not just knowledge, clarity is power. So what we're talking about here today is all the stuff that's going on in the CARES Act, and how we can take advantage of that, based on our own particular situations. So once again, thank you very much, for spending your time with us today. And we want to invite everybody to let us know what sort of questions, what sort of topics that you guys have in mind. We'll love to partner with other professionals and bring them over on these webinar series. We're going to try to do this once a month, where we can learn from each other once again, and really understand what is there out there that we can take advantage of, that we can be a part of, where we can go from one place to the other. So we'd love to do that. We would love to schedule a 15-minute call with each of you guys, or a Zoom session, really just to kind of understand who you are, and help us let us know where you are on your point of journey in terms of investing. And if there's anything we can do to help you guys with that on that journey, we'll be more than happy to do that. And remember, your business grows to the extent that you grow, right? And so let's keep these conversations open. Let's learn from each other, and let's kind of take everybody from one step to the other. And once again, Angie, thank you so much. And this is my CARES. This is my COVID salutation, and of course our Punjabi salutation. Thank you for everything that you do, and thank you for everything you do for your clients, and in terms of helping them understand where things are in their world, and hopefully bringing clarity to life at that point.
Thank you. I'm happy to be here, and thank you for the opportunity.
Great. So as Param said, we did record this session. Any parting words, Param, before we end the meeting?
No, I just want to say thank you to everyone. Thank you, Angie. And we look forward to having Angie again, because I think there's so many topics that we can learn from her. So we look forward to having you back as well, Angie, and on another topic. And thank you again for today.
Absolutely. Yeah, the tax code is what, 70,000 plus pages long.
Yeah, I think we can get into some detail. Exactly. Great. Thank you all.
Bye.
Have a great night.
Have a good evening.
Oh, better stop sharing.